8 months ago, I did something that was pretty scary. I took £20,000 of my hard-earned savings, the biggest lump sum I've ever had in one place, and I put it all into the stock market in a single click. 5 months on, and I did a video update telling you what the investment returned, and it was great news. It was up by £2,238, which is over a 10% return in just 5 months. It was great, and I was over the moon with the result. But that perfect track record didn't last long, and recently I've been getting questions asking how much is the investment worth now since the war broke out and the stock market has taken a hit. So if you're sitting there wondering, is now a good time to invest? I'm here to give you an updated result and to let you know exactly how I decide whether it's the right time to invest my money. There's even a link in the description if you want to talk to me directly. Just know that I'm not a financial advisor and this isn't financial advice. Your money is at risk when you invest. So, how did I pick my perfect moment to enter the stock market? The short answer is that I wasn't thinking about external factors such as how the market was doing or when I thought it was going to crash. Instead, my investing journey has always been more about me. In my last update, I explained that I'd been trying to come up with my perfect investing strategy after reading a book which helped me to understand how much I could be losing out through sitting on the sidelines, through choosing not to invest because I was either too afraid to start or unclear on what move to make next. So to avoid missing out, I broke down the barriers to me investing. I explored the things that were holding me back. And firstly, it was choosing if I could even afford to put that £20,000 into the stock market. The main criteria here is how much time you can go without having access to the money. For me, I'd been wondering if I needed it for a house deposit, and if that was still on the cards, then I wouldn't have invested it. The stock market fluctuates a lot, as you'll see by the end of this video, and there have been years where the exact fund I'm invested in actually dropped by around 20% before picking back up. The good news is that these fluctuations tend to even out over time, so if you have at least 5 years or possibly even longer that you can go without relying on the money, then you've reduced your risk of losing out and successfully overcome the first big barrier to investing. The next hurdle for me was understanding if investing was going to be worth it financially. Basing it on past performance, there's a chance that I could get a 10% return on average over the long run. While we can't say that for certain, it could be that my 20k would grow into £200,000 before I reach retirement. Even if I didn't want to wait that long and assuming there were ups and downs along the way, then the gains would still possibly even out to around £2,000 per year. That's the outcome we can assume if we take the past performance as our best guess. Although, as you know, past performance doesn't guarantee us those results. Also, when you take a long-term view, the individual crashes of the stock market matter much less because even after a significant dip, the market has always eventually recovered. It might have taken a few years to do so, but it's come back to all-time highs each and every time. Now, just to be clear, we're talking about the stock market as a whole here and not individual companies, which can have their share price drop down all the way to zero if they go out of business. Armed with this knowledge, I knew that for me, it wasn't about picking the best time to start investing. It was all about being in a position to be invested in the first place, and into something that wouldn't be as risky as an individual company. So I chose a fund called ACWI that seeks to track the performance of stock markets in developed and emerging market countries. In other words, it tracks thousands of companies across the entire globe. I also went online to check the exact fees I was getting myself into and saw that it was going to cost me just £12 per year to invest my £20,000 lump sum using Trading 212. Now, I wouldn't suggest that you just automatically do what I do or pick the fund that I did, because there's actually a lot of different investment options you can choose from that might suit you even better. But hopefully this at least gives you a taste of what's out there. You can use this story as a starting point for your own journey. I could even coach you through it if you want some more help, and I've got a website linked in the description where you can book a call to talk to me directly. All that said, you want to know how much my investment is worth today. Well, back in July, I invested £20,135, and now, 8 months later, that pot is worth £22,794. That's an unrealised return of £2,659, or over 12%. If this carried on for a whole year, I'd still be on track for an annualised return of 19.9%. So even though you can see the growth has slowed down a lot since earlier this year, I'm still up by quite a bit overall, and it's even increased a little bit in value since my last update. So even among all the negativity, it's often not as bad as the media makes it out to be. To be fully transparent though, let's look at the worst part of this update, which is that my investment has fallen in value by £180 since this time last month. Obviously, it's not nice to see the value go down, but this is just the way it is with investing, and I've been through enough through the past 5 years of tracking my own investments to know that the drop is just temporary. Next, I want to show you something which you might not have seen before, but it's my 20k investment in real time. Now, chances are the numbers showing up right now are different to the number reported in this video. That's because it's been a few days since I recorded the value of my portfolio. It's also likely to be changing constantly on screen, so that every few seconds it jumps up or even down by a few pounds or so. This is showing the shifts going on in the stock market. Now, I want you to imagine how it would make you feel if that were your hard-earned savings that had been put into the stock market. Potentially you'd be feeling different depending on if it's currently trending upwards or down. But it proves my point in saying that the hardest part with investing is actually psychological, as you don't always know how you would react when markets are falling or rising rapidly. Letting emotions get in the way of it isn't likely to improve your results, and yet we're all human, and so it's totally normal to feel emotions when it comes to money. But it's not something to be afraid of, because, like me, you can build up the courage to invest and trust in the power of time, patience, and consistency to grow your wealth too. It's just a matter of breaking down those barriers one step at a time.